You can see during recession, so 2000 to 2002, velocity drops at an accelerated rate. You saw that again in 08, 09, and you really saw it during COVID. And what's happening now is we're just moving back to trend. And I think trend is at about 1.4, so we have a little bit more to go. But if we do enter a recession, and as you know, we think we've been in a rolling recession for roughly 2 years now, starting with back-to-back declines in real GDP in the first half of 2022. And of course, we've seen housing measures drop by up to 40%. Autos are in recessionary territory. We're seeing non-residential construction, especially in the office space area, in desperate straits, offset somewhat by IRA spending, the Inflation Reduction Act spending, which is focused more on infrastructure. So now let's go into, one other metric that I wanted to share. We did this last month as well, but I forgot to mention something. So this is the yield curve. It's the difference between the 10-year Treasury yield and the 2-year Treasury yield. And during recessions, and the recessions are in the shaded areas there, the yield curve either goes negative right before the recession or in the middle. You can see for the most part, it is a leading indicator. In the 80s, it was late 80s as well, into the 1990 recession. It inverted again. Inverted means went back below zero before the 2000 tech and telecom bust. Same thing with 08, 09, and here we are again. You can see the yield curve is inverted by more than in any other recession, except the 80s. Now, the other thing that I wanted to mention here is you see where the yield curve goes during a recession when the Fed is stimulating and fiscal policy is also stimulating. Okay, now on to economic indicators. Here is a chart showing what expectations have been for fourth quarter GDP growth ever since October. And you can see in the GDP now purple line there, the growth expectations have been coming down. Bloomberg expectations were very low and seem to have come up, but they're both converging into sort of the 1 to 1.25 range, which is very low, of course, and not too far from negative, which is where we would not be surprised to see real GDP growth go some point next year. Now, we got consumer sentiment measures today. You can see, just going back into the early 80s, you can see that consumer sentiment is quite depressed by historical standards. We did get a little bit of a pop today. We've been hovering in that 60 to 70 range. Got closer to 70 with today's reading from 0.25 to 5.5% in little more than a year's time, has been slaying a dragon. We don't think that dragon existed. And we do think we'll see the ramifications of this policy during the next year or so in the form of much weaker than expected inflation and economic statistics. We wouldn't be surprised to see the broad-based inflation gauges go negative. And then, of course, the Fed will be fighting a completely different battle. Here is temporary help employment. You can see it's a leading indicator. The green line is total employment. Temporary help is the purple line. And by this time in past cycles, the total employment was about to turn down when temporary help had reached this kind of a decline. And we do think that will happen next year. That's part of why we think consumption will pull back. Purchasing Managers Index, this gives you a sense of where we are, tended to be closer to 17 million units, and we're at 15 million now. And we are beginning to see that in order to sell cars, auto companies, auto dealers are discounting more aggressively. One of the reasons they are is used car prices are starting to come down in a fairly dramatic way. They're down only 5% on a year-over-year basis, but taking a shorter term time frame, they are down more, and we think they will continue to move down. Here is China's PPI. One of the things we've been saying, and we've gotten some proof of it recently, is that China is exporting deflation. So you can see that its PPI is the purple line, down. It's been fluctuating in the down 2.5% to 5% range. And import prices from China are down roughly 2.5%, but deflation. And there are many companies now that have been relying on pricing to sustain their margins or even increase their margins. They're going to lose that pricing power. They already are losing it. And we think their margins will be under severe pressure unless they use technology. Innovation solves problems. Use technology to shore up margins. So now let's go into market indicators as we wrap things up. I did show this chart, I believe, last month, and I'm struck. It's just astonishing to me that commodity prices today are where they were in the early 80s. Now, given the inflation rhetoric you hear out there, you'd not imagine that to be the case. It was more the case that we had an inflation problem before the 08-09 meltdown. We thought we'd be looking at a comparison November of a year ago, November, December, closer to 70, say 75 to 90. So 20% plus increase year over year in oil prices. And I think that's why a lot of economists and strategists ran with the higher for longer Fed policy. Instead, what do we see? We're now negative on a year-over-year basis, negative oil on a year-over-year basis. And it is pretty astonishing that OPEC is cutting back again, being forced to, and the market's not paying any attention. Why? Demand destruction is real, and it's coming from China. It's coming from the rest of the world as well, perhaps because of hybrid and remote work. And